Welcome back. I'm Zinati Kumba and you're watching Trade of the Week. And today we unpack the Signia Itrix New China Sectors ETF, DRD Gold and Life Healthcare with founder of Herenya Capital, Petri Redelinghuys. Thank you so much for your time, Petri. I actually want to start off with gold. DRD Gold, it actually came out with results. When was it last week? It was the 14th of February. Of course I remember. Gold and Valentine's Day, they go really well together. So looking at, DRD Gold, it's seen as, one of the good gold companies, 17 years of uninterrupted dividends. But obviously a lot of analysts, say that gold is mostly for short-term trading because obviously these gold counters are influenced a lot by the gold the gold price. Would you say that is the safest way to play gold miners, and would you put DRD Gold in there?
I think that there's a much ruder saying about gold stocks that I won't repeat here. But essentially, yeah, gold stocks are very cyclical in the sense that they respond very strongly to bad economic conditions and times when people, flight to gold.
Mm-hmm.
So gold sort of trading at or near record highs is definitely something that's going to drive the gold price. But then, good times come along again and risk is reduced and gold stocks come down. So just by sort of means of illustration, this is a weekly chart of DRD Gold over the last couple of years. And you can see how we have these massive pushes higher followed by long periods of sort of just tapering down, and then you get a massive push higher and a long period of tapering down. So this is part of that argument why gold stocks are really not necessarily for long-term investing, but rather short-term trading, because it gives you great opportunities to take short-term trades, but not necessarily great opportunities to invest for the long run. I mean, if you look at other gold stocks like Anglo Gold, for example, very similar looking chart, right? They sort of go zero to hero, back to zero, back to hero, and they just do that over a very long period of time, right?
And they seem to be on zero for a longer time than they are on hero.
Look, remember, they're very geared to the gold price. So in times where now, for example, the gold price is sort of trading relatively robustly, it does make a bit more sense for the gold stocks to start running a bit harder, and they haven't just yet, which is what has our ears kind of prickled up, and this is why we're paying so much attention to them. So Anglo Gold, for example, Goldfields is another one to look at. Anglo Gold is probably our favored pick in the sort of entire sector. However, we think DRD Gold offers a little bit of value as well, and we kind of like the long trade from this level that it is here. So if you have a look, we'll just sort of switch back to a daily chart. So from a much longer term perspective, this level over here seems to be quite significant. Let's just make that a line that we can see. There you go. So that level seems to be relatively significant, which is kind of where we are. Look, it's not perfectly drawn, but which is kind of where the stock is trading at the moment. So we think that we could potentially see a bounce or a mean reversion here, essentially a move back up to this 200-day moving average. So we're sort of 1325. At the moment, so we're looking at potentially 17 Rand 50 in percentage terms. That's a colossal move. So a great trading opportunity, and like, as I'm sure you've seen by now, a lot of the trades we do are very high probability, right? In other words, if we get it wrong, we have a very tight stop loss. If we get it right, there's a lot of room for it to move. So that way, you have to essentially put the hammer down on the ones you get right, and you get lots of little ones wrong relatively regularly, and then the one or two that really work out. In theory, well, statistically, we're doing around 51% of the trades that we do are profitable, and the rest are very small losses. However, with situations like this where you could put a relatively tight stop loss, I mean, you could essentially put a stop loss below Friday's close with a massive amount of upside there if you get it right. So if you get it wrong, not necessarily a couple of $100 lost. If you get it right, a couple of grand in the bank.
Yeah, I mean, gold doesn't do well in a high interest rate environment, but I mean, you said that it's been trading quite robustly at this point. Would you say that there are other factors, other dynamics in the macroeconomic environment that are really supporting gold at this point where investors are kind of shrugging off the high interest rate environment?
Look, I think that this I've been saying this for a long time. At some point, someone's going to tease me for the broken clock is right at least twice a day, right?
Yeah.
But I do think that the economic situation in the US is worsening, and we saw Nvidia essentially knock it out the park.
As it's done time and time again.
The heavens opened and the sunshine came down and Nvidia rallied like you wouldn't believe, right? However, that furthers the problem where we have the situation where an enormous amount of concentration is taking place in a very small number of shares, and that's driving the entire market higher. We are still of the view that China outperforms from here, and so does commodities. And in that scenario, obviously, gold might perform well as well. So if we start seeing the US Fed cutting by the sort of second quarter, call it second or third quarter of this year, so about halfway through the year, I think we start seeing gold price react quite positively.
Talking about, how just lastly on gold, the economic situation is shifting, and also now you're getting a lot of central banks accumulating a lot of gold for their reserves because of the geopolitical situation. Do you think that we've gotten to a place where maybe gold has rebased a little bit, maybe to a higher price than we've seen historically?
So I saw an interesting stat. I can't remember, and don't quote me on it. I don't know the exact numbers, but I saw an interesting stat which was around an average house in Johannesburg would cost you, I think, sort of 317 ounces of gold.
Oh.
Many moons ago. We're talking like 100 years ago. And now that average house costs you around 63 ounces of gold.
That is very interesting.
So, from a long term, so look, in our country, it's a bit of a different story. Our currency's devaluated a huge amount. There's been a lot of sort of economic contraction over the last period, so all of those things tend to play a factor. But if you take, for example, that 100 years ago to have a handmade tailored suit made for you by a tailor, that would cost you, 1 ounce gold coin. And if you think that in today's terms, if you had to have a Hugo Boss suit hand fitted for you, that would cost you around 40 grand or so, right? That's about a gold coin. So a protection, a store of value is essentially what it does. It protects your money from inflation. And what we've seen over the last period is an enormous amount of inflation taking place in almost every currency on earth, which naturally is an upward driver for the price of gold. Whether or not gold's values increased relative to what it was 20 years ago, we can debate that, because you can essentially buy the same amount of hamburgers or the same amount of suits, or maybe not in the case of South Africa, but in most sort of developed economies, the value of gold is roughly the same. However, the price is multiples higher now than it was in the 70s or the 60s, for example. So from that perspective, I think, yes, there's an upward bias towards gold price, and then inflation has a big influence on that.
All right. Well, you spoke about your thesis of China outperforming. So let's actually get to the ETF Signia Itrix New China Sectors.
It's a mouthful.
New China Sectors. So what does that entail?
New China Sectors ETF is the
Yes.
So essentially what it just does is it backs the broader mainland Chinese economy, right? So you get some tech-focused ones, and you get some, sort of industrial-focused ones, and this is a very broad-based one. It kind of looks at the entire Chinese economy. So if you look at...
so it's quite diverse.
Quite diverse. It's kind of like the Hang Seng Index, right? So for an easy way for investors to back South Africa's performance, you can buy the top 40 index. For an easy way for you to back Chinese overall performance, you can buy this New China Sectors ETF. So we think this is a great ETF to get involved in, and what we can see here is that we've seen a bit of a downtrend. Now, the chart looks a bit blotchy, so it's probably better to actually put it on a line chart. So I'll do that, simply because being an ETF, it's not the world's most liquid share, right? So it does sometimes, you know what, I'll do that so that we can preserve our moving averages. I'll take them away. Okay, let's make this one, let's make it red.
All right.
Sorry, doing
maintenance. No, it's interesting.
There you go.
It's interesting seeing you do all your artwork.
So essentially what we have here is a bit of a downtrend, which looks to have been broken now. We've had a bit of a movement up, if you can see here from the stochastic as well. We're going to do some of this. So we have higher lows here on that stochastic oscillator over there, while on the price we have the corresponding period is lower lows, right? So that is obviously a little bit of divergence, which leads to this power move that we saw up here back towards the trend line. So we think that there's at the very least, a little bit more room to go up to touch this 200-day moving average. Beyond that, if we break this, I think we see a longer-term trend change. So just to zoom out a little bit, and for the sake of ease, I'll remove that. Wait for a bit more data. It's not very old. I think that we could potentially see this overall downward trend essentially changing to an uptrend. And if we start to see Chinese outperformance of the US, I think that this ETF is going to do really well. If we look at the sort of Hang Seng index, as a whole, you can see that there is potentially an enormous amount of upside to be had. So we're backing this Hang Seng index by buying this ETF.
Yeah, and I mean, it's quite interesting because those stocks have really been seen they are undervalued, where you've even gotten the Chinese authority going in now to the market to kind of prop up that market. So it's just too irresistible at this point.
I think so, yes. And I think that just from a long-term perspective, if you're thinking in the next 5 years or so, where are you really going to get outperformance?
Yeah.
I think you're going to get it from the things that have been hammered down a little bit. And I think that we're probably going to see it from the Chinese economy. The US economy, the economy at large is really tough. The tech stocks are really magnificent. The magnificent seven, right? So you've got a handful of companies that are doing extremely well. Everyone else, including the consumer, is struggling. It has to start slowing down. And we're looking at a Chinese economy that has been sort of in the doldrums for a while. The Chinese authorities and central banks are doing what they can to stimulate the economy, direct interventions in the stock market, for example. So I think that there's a lot of upside to be had in China. So you could even potentially do a short S&P 500 long Hang Seng trade if you were a bit more. It's a bit more market neutral. Well, not really market neutral. It's a bit riskier if you ask me than just rather going along the one. Because you're kind of betting against one.
Exactly.
So it is slightly riskier, but I think it would probably offer a very good return.
All right. Well, let's go into Life Healthcare. Quite an interesting one because we saw quite a lot of optimism there after it announced its intention to dispose of its AMG business last year. Of course, that's now done, I think. But I was actually just looking at that share price, and after all that plowing in, it seems that there was some slight pressure on the share. What is that looking like? What's a healthy way to play the stock?
Look, I mean, I might end up eating hat here, and that's fine. I've come to learn that hats are quite tasty at times. So the idea here was to sort of buy it off of this support line over here. You can see that it's been sort of tested a number of times. As it trades at the moment right now on this day down 1.3%, it is firmly below that trend line. So from a risk reward perspective, I suppose now is a really good time to buy it. You could probably stop out sort of below 17 Rand 25 if you really want to give it a lot of space to move. You could stop out below 17. And again, your target is this 200-day moving average. So I'll just draw in a little risk reward indicator here. So if we are targeting up there and we're sort of risking all the way down to 17, that looks about right. We can actually put it there. Let's say just below 17. That gives us a relatively good risk reward ratio of 1 to 4. So I'm quite happy to take that trade. It is bottom picking a little bit. It is slightly higher risk. I think that this is also just one of those things where the overall sentiment of the market has really been hammered down. Just for context, I want to show you kind of what we're dealing with here. The US market is really trading sort of very, very high, while our market has really not done too well. Let's just have a look at that. See, our market has not performed that well at all, right? So I think that we probably are better off. Again, we're looking at that sort of long South Africa, short developed world potential trade. So I think that, maybe it's bottom picking something like Life Healthcare a little bit right now, but I think there's a very good risk reward on offer here. And even if you have to take a few paper cuts along the way,
Yeah. Okay.
You know, the big trades are worth taking a chance for.
All right. Well, let's get to the educational segment. We have touched on trailing stop losses before, but now you want to get deeper into
Right,
that.
I think that, yes, I think last time it was a bit confusing, right? And I think that it might have been a bit simpler. So this is actually a presentation I did some time ago. If you do want to download it for yourself, you're welcome to head over to our website. It's available on our presentations tab. There's videos and all sorts of stuff for you to watch. Essentially, this talks about an ATR times 2 trailing stop loss. So there's a bit of an explanation of how average true range is calculated. We won't get into that too much. Essentially, it's an indicator that you put at the bottom of your chart. So I'll put it on for the sake of reference. So there's an average true range indicator. And it shows you that the average true range of this stock over the last 14 days is what? 32 cents. So on an average day, it moves 32 cents either up or down.
Oh, okay.
Right?
Yeah.
So we're taking that average true range, we're multiplying that by 2 to get us to what is, in this case, it would be 64 cents. And then that is how far we put our stop loss below or above our entry price, right?
All right.
So the example that we have here is on a short trade, where the ATR is 1.72, or ATR times 2 is 1.72. ATR comes in at 86 cents. Our entry here was 108 and 8 cents. Our stop loss is then 109.80. And then as the stock sort of moves down, there's a number of things that happen here. Once our ATR times 2 trailing stop loss is far enough, or the price has moved far enough down in this particular scenario, okay, with a long, please, the opposite of everything I say. But once the stock has moved far enough for your ATR times 2 calculation to be sort of at your entry price, then you set your stop loss there.
Okay.
And every day that it moves further in your favor, you do that calculation and you move your stop loss again. Every morning you adjust your stop loss so that as the stock moves further and further in your favor, your stop loss is kind of trailing along with it.
Okay.
And then eventually the market sort of turns around, bounces, and your ATR times 2 takes you out. So you don't get the exact bottom or the exact top of a potential trend, but you do get a you do get a fair chunk of that move, which is a very much lower risk of doing that. So it's very simple. Constantly trailing it. So very simple. Work out you put on the ATR indicator. So for this, for example, on Life Healthcare, the hard stop loss would be at 16.97, right? And once it is in the money to the point where it is now my ATR times 2, which in this case is 64 cents, is the difference between where the price is and where my entry price was. Then I switch to the ATR times 2 trailing stop loss. And at that point, I just allow the trade to run and I ratchet my stop loss up every day until such time I get taken out. So potentially it blasts past this and goes to 22. I mean, we'd only be too happy if that's the case. But you know, if it doesn't, then at least we can lock in as much of that move as we can.
Who knew that I could learn something new, Petri? With all the knowledge in my brain. Thank you so much for your time. Really, really appreciate that. And thank you for making that simple enough for us. That was founder of Herenya Capital, Petri Redelinghuys, with this week's Trade of the Week.